In every nation on Earth, behind the appearance of stability, progress, and economic growth, there exists a hidden flaw, quiet design feature that guarantees collapse is not an accident, but an inevitability. A silent failure built directly into the structure of every modern monetary system. And the real mystery is this: if the people in charge know the system contains a self-destructive loop, why does the world continue using it? To understand that, we must go back to the origins of money itself, long before digital currencies, long before central banks. To a time when value was tied to physical resources, gold, silver, grain, livestock, things that could not be printed, manipulated, or conjured out of promises. But as civilizations expanded, empires grew, and wars demanded financing far beyond the limits of real resources. Leaders and early bankers discovered a powerful trick. Money didn't have to be a physical object. It could be a claim, a promise, a representative symbol of value, rather than value itself. And with that shift came the earliest cracks in the system. The rise began with paper notes backed by gold, which created flexibility, but introduced trust, meaning wealth now depended not just on resources, but on human decisions, political pressures, and financial incentives. Then came fractional reserve banking, a tool that allowed banks to lend far more than they actually held, multiplying money through credit and pushing economies to grow faster, but also making them more fragile. The real breaking point, however, came in the 20th century, when central banks were created worldwide to manage this increasingly complex system. And after the Great Depression and 2 world wars, nations began abandoning strict gold convertibility, culminating in the pivotal moment of 1971 when President Nixon ended the Bretton Woods Agreement and severed the dollar from gold entirely, transforming global money into something unprecedented: pure fiat currency backed only by government decree, belief, and monetary policy. From that moment onward, the structure of the global economy changed forever, because without the discipline of gold, money supply could expand endlessly, credit could grow without limits, and governments could accumulate debt without the immediate consequences that had constrained them in the past. And this created a feedback loop, where growth required more debt, and more debt required more currency printing. More currency printing eventually diluted the value of money itself. This is where the silent collapse begins. In a debt-based monetary system, every dollar comes into existence as someone's liability, meaning money can only grow if debt grows. And because debt requires interest, the system must keep expanding, or it seizes up, creating recessions, crises, and collapses. This is why inflation is not an accident. It is the mathematical result of money creation outrunning productivity, a slow erosion of purchasing power that quietly transfers wealth from the public to the institutions closest to the source of money creation. The breaking point appeared in 2008, when the housing bubble fueled by decades of cheap credit exploded, revealing just how fragile the system had become. But instead of allowing a natural reset, central banks intervened by slashing interest rates, injecting trillions into financial markets, and effectively rewriting the rules of monetary reality to keep the system alive. Actions that prevented collapse but deepened the underlying flaw. The fallout was profound. Asset prices skyrocketed, benefiting those with investments, while wages stagnated. Inequality widened as everyday people found themselves priced out of homes, education, and basic wealth-building tools. And governments became increasingly dependent on borrowing to fund basic operations. By the time the 2020 global crisis hit, the system was already stretched to its limits. Central banks responded with unprecedented stimulus, massive printing, near zero rates, and emergency liquidity, increasing the money supply by trillions within months. A move that stabilized markets, but triggered the inflation waves we see today. Attempts to fix the system repeatedly failed because they never addressed the core flaw. Modern monetary systems rely on perpetual debt expansion, meaning if the economy slows, if people borrow less, or if governments try to reduce debt, the system enters deflation, unemployment rises. Businesses collapse, and governments panic, forcing central banks to intervene again with rate cuts, printing, and liquidity injections. This creates a cycle where each crisis demands a bigger fix than the last. Each fix inflates assets further, and each inflation wave accelerates the eventual collapse of purchasing power. The parallels to previous historical collapses are unmistakable, from the Roman Empire's currency debasement, to Weimar Germany's hyperinflation, to the collapse of the Soviet ruble. Every system that shifted from resource-backed money to unchecked currency creation eventually reached a tipping point where trust evaporated. Inflation surged, and the public bore the consequences. Today's data points echo these patterns. Global debt has soared past $300 trillion. Central banks hold trillions in government bonds. Inflation swings wildly across continents. Housing affordability has collapsed for an entire generation. And currencies are losing value faster than wages can catch up. Meanwhile, new proposals, like central bank digital currencies, CBDCs, promise efficiency but also introduce new risks: greater control over transactions, programmable money, and the potential for direct manipulation of spending, saving, and privacy. The repeating pattern is clear. Each modern monetary system built on fiat currency and debt eventually reaches the same structural limit. Where debt grows faster than the economy, interest becomes unpayable, and the currency gradually collapses in value, not suddenly, not dramatically, but silently, through inflation and declining purchasing power that erodes wealth without ever being labeled a crisis. 3 lessons emerge from this story. First, every fiat-based monetary system contains the seeds of its own collapse, because it relies on infinite expansion in a finite world. Second, those closest to money creation benefit the most, while the public experiences the long-term erosion of wealth. And third, the system can continue longer than anyone expects, but not forever, because confidence, not gold. Not productivity, not government authorities, the only thing holding it together. As debt grows, currencies weaken, and central banks face unprecedented pressure. The question is not whether another reset is coming, it is what form it will take. Who will bear the cost, and what new system will emerge from the collapse of the old one? If you want to understand the hidden mechanics behind global finance and prepare for the changes ahead, subscribe and follow this series as we continue exposing the structures, patterns, and decisions shaping the future of money.